Hi everybody, this is Greg Gossett with Gossett Trading and Mentoring, and today is Saturday, September 20th, 2025. I hope you're doing well. I hope you are having a nice weekend, and I hope you had a good trading week last week. Boy, the market's been on a tear, that is for sure. And will it keep going? It certainly might. Will it stop going up and go down? It certainly might. So, it's important in trading that you just follow your signals, your process, and sometimes like this, when the market keeps going up, it's really great for our traders, great for us as traders. So, the format for today's podcast is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the positions that I have, all the trades that I made last week. We're going to talk about when I entered the trade, why I entered the trade, what the setup was, what the confluences were, and then most importantly, how I am going to manage the trade going forward. After we go through all the positions, we're going to talk a little bit about trader psychology. It is the most important skill in trading, is the ability to create a plan and simply follow it. They're just 95% of people would just improve their trading results dramatically if you just get yourself a decent process, a decent strategy of how you're going to trade a market, and then follow it. I've been trading for over 30 years now, and every single day that I continue to trade, I realize this is more and more true, just because of other traders I work with other students, with students that I work with. I just see the results just improve and improve if they simply follow their plan. All right, and that comes down to trader psychology. Not getting impulsive, not doing things you're not supposed to do, not getting out when you're supposed to, staying in when you're supposed to, just as important, right? And so I like talking about trader psychology. I like teaching it. It's helpful for me, and I hope it's going to be helpful for you. After that, I did go down through my master watch list last night. I do it every Friday night. And I go down through all the stocks on my watch list one by one, and I look for potential trades for the upcoming week. I look for confluences and levels where there's combination confluences of signals of support. And if they get to those locations, then I will consider taking the trade. If they don't get to those locations, I just move on and I wait for a market that does get to where I want. And I'm looking for confluences of order blocks, major moving averages, key RSI readings, like an under 30, over 30. Looking for V1s, looking for bullish abandoned babies or bearish abandoned babies if I'm short. And ideally, as many of these happening at the same time, because a lot of times you can get multiple signals at the same time, and those are the type of signals that put you in a position to have the best possibility of a potentially profitable trade. So I have highlighted 9 different markets for the upcoming week, and we'll see if any of them get there, but I'll go over what I'm looking for, and I'll go over the levels and the confluences that I'm looking to happen for next week in order for me to consider taking the trade. So I hope it's going to be helpful for you to take a look at the positions that I have, why I entered, how I'm managing those, and then again, the signals for next week. And if you do find it helpful and you do find it valuable, I would appreciate it if you could hit the thumbs up button. It really does help out, lets YouTube know that there's some valuable content here so they can share it with more people. And if you haven't subscribed, I appreciate it if you would subscribe. And I try to put out as much helpful content as I can each week. So let's go ahead, get the U.S. legal disclaimer out of the way. And once we're done with that, we'll come back and we'll get started. So hang tight. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here, and here. Thank you so much.
All right, well, let's get started. First one on deck is Netflix. And so on this first position, I'm going to get a little bit more into detail of how I position size, how I place emergency stops, how I take partial profits. And then after we're done with Netflix, I'll go a little quicker just for time's sake. So this is Netflix. And whenever you see a green box, this is what's called a bullish order block. And order blocks are a big part of my trading, and really helpful, done very well for me. And you really should look into order blocks if you're wanting to become a better trader. You should really learn about order blocks and how to use them because they are powerful. So first of all, what is an order block? Well, an order block, when I'm looking to enter a trade, like I did enter Netflix here on August 7th at 1181. So why did I enter this, and what is an order block? Well, the order block starts over here on 529.25. So what is an order block? An order block is when you have a swing low, which is here, then you have a swing high, which is here, followed by another swing low that's lower than the first swing low. And then in the future, if the market moves up over that first initial swing high, that means you have changed structure to the upside. And as soon as you change structure to the upside, the lowest closing bar before market structure change becomes your order block. So you have the high and the low of the lowest closing bar before market structure change, and I take the high and the low and I move that into the future. So here, when we broke market structure to the upside, I want to buy dips back to the order block. And you can see we broke market structure to the upside. We pulled back into the bullish order block and took off from there. Now, I didn't take this trade, but going forward into the future, this is still going to be a key area to base entries and exits from. And there's many ways that you can take entries off of an order block. You can take it if it comes down to it, rejects the high of the order block. You can take it if it comes down, tests the low of the order block. Or if it closes below the order block and then closes back in the order block, that's also a location. You can take entries inside the order block if they occur with major moving averages or even 30 RSI levels. So there's all sorts of different ways to enter, and I have a lot of positions today, so you'll see a lot of different entries that I took, but the majority of them are going to be based upon the order block. So I entered Netflix here on the 7th of August at 1181 because previously we were below the order block. We closed below the order block, but then we closed in the order block. So this was my entry, 1181. Now, as soon as I enter the trade, and I tell people this, I tell students this all the time, your position size is literally the most important thing. And so let me just explain to you how the two inputs that I use to come up with how many shares I'm going to buy. It's very simple. The first is how much do you have in your trading account? Okay, let's just say I have $50,000 in my trading account. I take 1% of whatever my trading account is. 1% of 50,000 is $500. And then I divide it by the value of the 2 ATR. Right now, the value of the 2 ATR is 53.96. So whatever the 2 ATR value is on the day that I'm going to enter, that's what I use. It will change every day. So 1% of my capital, $50,000 capital, 1% is 500. Divided by the value of the 2 ATR, that shows me how many shares to buy. If I have $100,000, 1% is $1,000. Same, divided by the value of the 2 ATR. Or $1 million, $1 million, 1%, 10,000, right? It works with whatever you have. So $50,000, 1% of that is $500 divided by, we'll just do the math here, 53.96. Tells me to buy 9.26 shares. So I'm just going to round that down to 9 shares. So based upon the volatility of the market, and that's what the 2 ATR is telling you, and how much money I have in my trading account, that is the correct amount of shares for me to buy. So I buy here 1181. Now, the first thing I do is I look back to the 2 ATR because I just did the math with the 2 ATR. I take my entry minus the value of the 2 ATR and I put a red line there. That is my emergency stop. So if I have 9 shares and it moves down 53.96 from below my entry, how much have I lost? I've lost $500, right? 1% is the maximum that I'm going to allow myself to lose on a trade. And so if 9 shares moves down 53.96 points, I lost $500, right? But that is my emergency stop. And the good news is that I only hit my emergency stop approximately 5% of the time. The other 95% of the time, if I have a loss, it is going to be because my end of bar stop was triggered. Well, what is my end of bar stop on this trade? My end of bar stop would simply be a reversal of why I took the trade. I took the trade because it rejected the bottom of the order block and closed in the order block. Therefore, let's just say the next day it had closed below the low of the order block. I'd simply get out. It's much, much closer than my emergency stop. My emergency stop is a 1% loss. If the next day it just closed down here, maybe I would have lost 1/10 of 1% or 0.2 of 1%, right? Because my maximum loss is 1%. So I always use 2 stops. Emergency stop, worst case scenario, I lose 1%. The end of bar stop, even if I have a loss, ideally it's going to be much less than the 1%. And it's all about risk to reward. If the next day it closes below this order block, I have a very good risk to reward. If it goes down, I'm out quickly. If it goes up like this has, then I have the chance to make a lot more than I was risking. Make sense? Okay, so I took the trade with the rejection of the bottom of the order block. I position sized. I placed my emergency stop 2 ATRs below. Now the next thing I do is I go to my 1.5 value. Right now the 1.5 value is 40.47. This again changes every day. You just use what you have on the day that you take the trade. So the day that I took the trade, whatever the 1.5 was above my entry, I place an orange line 1.5 ATRs above my entry. And this is what is called my trailing stop level. If I take the trade and if it moves in the direction that I want it to, and it gets to my trailing stop level, it does not mean that I do anything. If it reaches the trailing stop level, all it means now is going forward in the future, I am in trailing stop mode. And what that means is in the future, after reaching trailing stop mode, if I have a close below a previous bar's low, I am going to exit half the position. So what this does is that it tightens up all of my stops. You've probably heard that, if you have a good trade, then you want to tighten up your stops. That is true. You don't want to give it all back. So if I have a close under a previous bar's low after reaching trailing stop level, just the fact that I sold half tightens everything up. It brings everything up because I took off half of the position. Make sense? So as we go through these, hopefully I'll show you some examples and hopefully that will become more clear in your mind. So now, everything that I've talked about so far, the emergency stop, the end of bar stop, the trailing stop level, these are considered defensive moves. If I enter the trade and it goes against me somehow, I take action defensively. But I also want to play offense in my trading. And the way that I play offense in my trading is I take partial profits if the market moves a certain amount each day from the previous bar's close. I don't take a full profit, I just take partial profits. So I'll show you exactly what I'm going to do because this is the trade that I have. The way that I do it is I just take the closing price of whatever position I'm in. Right now the closing price is $12.26.97. All I do is I take $12.26.97 And now I look for the value of the 0.45 ATR. Right now, the 0.45 ATR is $12.14. So I add the two together, $12.2697 plus $12.14. That is going to be my first profit target for Monday. And how much do I take off at that profit target? 10% of however many shares I go into the day with. If I have 10 shares and I hit the next profit, I hit that first profit target, I take 10% off. I take one share off. And I do this every day. But I don't just place one profit target, I place three profit targets. So I take the closing price plus the value of the 0.45 ATR. That's my first profit target. I take the first profit target, add the value of the 0.45 to it again. That's my second profit target. And I do it one more time. I take my second profit target, add the value of the 0.45 to it. That's my third. And these are just limit orders of 10% of however many shares I win today. I just put them in. If the market gets there, it just automatically takes it off. So I think it is extremely important to take partial profits when the market is giving you something. Not everything, but something. All right. So, okay, so that's kind of the basic overview. So let's just go through the trade. Again, we have an order block. I entered the trade on the 7th of August because it was below the order block and then closed back in it. Position size, 1% of my capital divided by the value of the 2 ATR shows me how many shares to buy. I placed my emergency stop, exactly the value of the 2 ATR below. My end of bar stop is simply a close below the low of the order block. See how close we are to the order block anyway? Next thing I do is I place my 1.5 ATR trailing stop level above, and now I'm ready to go. I know exactly what I'm going to do. Exactly. No surprises here. I know exactly what I'm going to do regardless of what the market's going to do, either up or down. So the next day, fortunately, takes right off for me, right? And these order block, many times on these order block entries, I experience this. The next day it takes right on off because other traders see this too. So the next day it takes off. I hit multiple profit targets already. I'm into trailing stop mode. I don't do anything. I am only going to do something now if I have a close below a previous bar's low in the future. Next day, up again. Next day, up again for a profit target. Next day, reverses. I have a close below a previous bar's low after reaching trailing stop level. What do? I sell half of however many shares that I have that day. And so I locked in 1.94% on half of the remaining shares, but I'm still in the trade. Next day, we continue up very strong. I take more profit targets off. Then we kind of move down here, nothing going on. I do hit a profit target here, kind of nothing. Then we head back down. I'm still in the trade, however, because we haven't closed below the low of the order block. Then we have nice 2 days straight up where I took off more profits. We go sideways, then we go down, and now we've had a little bit of a rally. So I've already gone into trailing stop mode. I've already taken off half the position. I'm selling into strength whenever it occurs, and the remaining shares that I have, remaining shares that I have in this position are up 3.7%. All right, and so just going forward, if it continues to go up, I'll continue to take partial profits. The only way I would get out of this trade to the downside is if it closes below the low of the order block. But so far it hasn't, so I remain bullish on Netflix and remaining shares up 3.7%. Okay, LUV, which is Southwest Airlines. This is a combination of a deep dip buy and a order block. Deep dip buy, whenever I say deep dip buy, I'm talking about a 300-day moving average, a 250-day moving average, a 300, 250, and 200-day moving average, or an under 30 over 30 RSI. So this is a combination. I bought here on the 21st of August at 31.08. Why did I enter here? Well, I have an order block. You can see the green order block. This comes from the past. And on the day that I entered, it rejected the 250-day moving average, which is the purple line. So this is a deep dip buy. Intraday rejection of the 250-day moving average inside the bullish order block. I enter, or I position size correctly. I do the math. I enter. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 250-day moving average, the purple line. Well, look how close I am to it anyway. If the next day it had closed below, I'd simply get out for a very small loss. Okay, I look 1.5 ATRs above. I place my trailing stop level. Next day takes right off. Huge day up again after the proper signal. I take multiple profit targets off, and I also get to trailing stop level. It's nice getting to trailing stop level in one day. Doesn't mean I do anything. It just means I'm in trailing stop mode. Next day, doesn't do much. Next day, another nice big up day where I continued to take, I took partial profits, 0.45 ATR profits into that big move up. And then next day doesn't do much. And then the next day we have our first close below a previous bar's low after reaching trailing stop level. I sold half of the shares that I had left go at the end of that day, tightening up everything by selling half. And I locked in a gain of 5.63%. Then we went down. Then we had a nice big up bar here, which of course I took more partial profits. Then we moved all the way down. Interesting, like here though, here's the 250-day moving average, the purple line. Remember, any close under this 250-day moving average, I am out. But the market respected this, never closed below. Here we have a nice day up, profit targets next day, profit targets. Then we came down again. We retested the 250, but was still able to close above. Here we have a big day up and up again on Friday. So the remaining shares that I have on Southwest Airline doing quite well, up 4.4%. Okay, let's go to ESTY. This has been a monster trade. And I entered here on the 4th of September at 52.55. Why? Well, you see the green order block, so it had to do with an order block, and the order block started all the way back here on June 30th, taking that order block, moving it into the future. And on this particular entry, I entered here 52.52 because it rejected the high of the order block. You can see during the day it went into the order block, closed back above it. That's a rejection of the high of the order block. Also, on top of that, we had a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes below bar 1's low, closes above bar 1's close. I didn't take the trade because of the V1. I don't usually take trades. Well, there is one situation where I will take it just based upon a V1 or a V2. By the way, if you want to learn more about V1s, V2s, go to my YouTube channel. I have a video on it. It's really good. I use V1s, V2s all the time. But generally, they're not a primary reason to take the trade, but they are a secondary reason. The primary reason on this particular trade, of course, was the rejection of the high of the order block. But on the day that I took it, there was a rejection of the high of the order block plus a V1. So it just improves the quality score of the trade. All right. So entered here with the rejection of the high of the order block plus a V1, entered at 52.22. I position size. I place my emergency stop 2 ATRs below. My end of bar stop is simply a close below the low of the order block. I place my 1.5 ATR trailing stop level 1.5 ATRs above. The next day takes off, moves up, I hit a profit target. Next day, big up day, I hit multiple profit targets, and I am also in trailing stop mode, which again means that in the future, if I have a close below a previous bar's low, I'm going to get out of half. Next day down a little bit, but doesn't close below the low, so I stay in. Next day up, profit target. Next day up again, profit target. Next day down. Next day, I have my first close below a previous bar's low after reaching trailing stop level. What do? I take off half of the shares that I have on that day to tighten everything up, tighten my stop up, and I exited half for a gain of 9.53%. Next day, we go up, more profit targets. Next day, up again, more profit targets. Thursday, up again, more profit targets. So I'm selling into this strength. So the remaining shares that I have on ESTY at the moment, up 19.59%. And again, why did I enter the trade? The rejection of the high of the order block. My risk to reward, this order block's pretty narrow. I have a pretty good risk to reward on this trade. If I'm wrong, I can be wrong small. If I'm right, like I was on this particular trade, I can be right big. And that's the important part of trading. Putting yourself into a position where if you're wrong, you can lose small, and if you're right, you can win big. Sounds pretty simple, right? That, when it all comes down to it, that's what trading is about. It's being very impatient with your losers and being very patient and having a process to follow so that you know what to do every single day. And so that you're not impulsive about it. I could have easily gotten out here and said, oh, that's a good trade. I'm out. That feels good. But if I would have not had a process, I would not still be in the trade up here. So really nice remaining shares up 19.59%. Let's go to Bitcoin. I have a lot of positions. Boy, I don't think I've ever had this many positions. But again, not all of them are full positions. You know, I'm getting out of half and so forth and so on. But it's just the market conditions as they are giving me these signals. So I'm taking them. This is BITO. This is an ETF for Bitcoin. I entered Bitcoin here on the 5th of September at 1923. Okay, what process, what strategy am I using with this particular entry? This particular entry, everybody, is called a bullish abandoned baby. Crazy name, I know, right? Well, let me show you what it's about. So you can see the red bar here that I've blocked, that I've highlighted with a green outline. This is an abandoned baby. What's an abandoned baby? An abandoned baby is when you gap down. So look to the bar, the left of the green area. We gap down. So overnight, we gap down for whatever reason. The sentiment on BITO, or on Bitcoin, was negative. Well, it gapped down, went further down that day. Well, then out of the blue, the very next day, it gaps way up. So we went from a very bearish sentiment to a bullish sentiment very quickly. When this happens, it's called an abandoned baby. And the reason they call it abandoned baby is because it's kind of left down here by itself. It gapped down and immediately gapped up. That is a bullish abandoned baby. A bearish abandoned baby is the opposite. You gap up, and then out of the blue, all of a sudden you gap down. That is bearish. But a gap down followed by a gap up is bullish. So when abandoned baby happens, like we knew the abandoned baby was created right when it opened, right? Because it gapped down and then it gapped up. You could see the gap down and the gap up. When the bullish abandoned baby happens, the high of the abandoned baby when it forms is a key level of support. And generally, the way that I do this is that once the abandoned baby is formed, if we come down, test the high of the abandoned baby and close back above it, that is my entry point. And that is exactly why I bought here at 1923. Now, on abandoned babies, my approach with managing these trades is a little bit different than if it's a deep dip buy or if it's a order block. I make it very simple. I place a 2 ATR emergency stop below, like I do with every trade. And then I place a 4 ATR profit target above. So my profit potential is twice what my stop level is. So I'm risking 2 ATRs to make 4 ATRs. This is proper trading. If I'm right, I'm going to make twice as much as if I'm wrong. Now, when these abandoned babies form, I just know from experience that more times than not, I'm going to hit my 4 ATR profit target instead of losing my 2 ATR. I'm certainly going to lose 2 ATR, but percentage-wise, I'm going to make twice as much more times than I'm going to lose half as much. Make sense? So this is the set it and forget it. I have a stop loss here at my 2 ATR stop. I have a order in to sell if it gets up to my 4 ATR profit target. So it's a set it and forget it type of trade. Eventually, I'm either going to hit the stop or I'm going to hit the profit target, right? Eventually, one of those two things is going to happen. And I'm just put it out there. Whatever one happens, fine with me. So that's what's happening at the moment. Currently, BITO on this abandoned baby trade is up. It's up 3.08%, but I'm not taking any action. I'm not doing any trailing stop levels, partial profits, anything. It's just, I'm either going to hit my 2 ATR profit target or I'm going to hit my 4 ATR. My 2 ATR stop loss or my 4 ATR profit target. So currently, Bitcoin in this trade is in process, up 3.08%. CRM. Okay, CRM, you see a box, but it's red. Red box means a bearish order block, and everything is reversed from a bullish order block. Remember, from a bullish order block, we're looking for a swing low, followed by a swing high, followed by a lower swing low, and then a move up, taking out that first swing high. That changes us from a bearish market structure to a bullish market structure. Well, this is just the opposite on CRM. We have a opposite. We need a swing high first, followed by a swing low, followed by a higher swing high, and then a move down below that first swing low, which changes everything from a bullish market structure to a bearish market structure. And when you change structure from bullish to bearish, I want to look to short rallies. Well, I'm going to look to the bearish order block. The bearish order block is the highest up bar close before market structure change. So here's the swing low, here's the swing here's the swing high, here's the swing low, here's a higher swing high. This move down takes out the first swing low. That changes it into a bearish market structure. As soon as it changes it to a bearish market structure, the highest up bar close is your bearish order block. And now I have to wait for a rally back into that order block. Well, that happened. And I was telling you earlier about having major moving averages inside of the order block to take the trade. Well, this is when I took the trade. The gray line is the 50-day moving average. It rejected, you can see it tested, and then closed below it. So that's a rejection of the 50-day moving average. But more importantly, it's a rejection of the 50-day moving average inside of the bearish order block. So I got short at 252.04. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop on this trade is simply a close over the 50-day moving average because I want to have that line in the sand. I want to have my end of bar stop be pretty close. Well, it's pretty close, right? I shorted here 252.04. If the next day it had closed above the 50-day moving average gray line, I simply would have got out. Now, because this is a short trade, I put my 1.5 ATRs below me, and the next day we nailed the trade. Immediately took off to the downside where I locked in multiple profit targets on the short side by buying back some of the position at a much lower price. And now I'm in trailing stop mode to the downside. Next day, we are up. We didn't change anything. The next day down, enough for me to hit a profit target. Next day down, not enough to hit a profit target. The next day down, profit target. And then the next day, I have to get out of half of my position because I'm short. This is the first time we had a close above a previous bar's high after reaching trailing stop level below us. And I took off half the position and locked in a gain on this short of 4.04%. And since that day, we have moved up, right? Again, my stop is going to be a close above this 50-day moving average. So going forward, if Monday it closes above the 50, I just get out. And I may still be able to get out on the remaining shares with the position, even if it closes above there. If it heads down and continues to head down, I'll continue to take partial profit targets. So I locked in a gain of 4.04% on half of the shares, and the remaining shares on this short up 2.06%. Boy, I have a lot of positions. Okay, Berkshire Hathaway. I entered Berkshire Hathaway back here on the 10th of September. Why? Combination of a bullish order block and a deep dip buy. You can see the black line is my 200-day moving average. That is a deep dip buy moving average. Well, let's start with the order block. You can see the green box is the order block. Why is it the order block? Well, here we have a swing low. Here we have a swing high, followed by a lower swing low, followed by market structure change. As soon as it changes market structure, the lowest closing bar before market structure, the high and the low of this bar moving forward into the future is my order block. And the reason that I took the trade here was that it did two things. It intraday rejected the 200-day moving average, and nicely, it also rejected the high of the order block. So I entered 489.46. I position sized correctly. I placed my end of bar stop 2 ATRs below. My emergency stop 2 ATRs below. Where is my end of bar stop? Simply a close under the 200. So I keep my risk to reward really good. So I entered here 489.46. Then I placed my trailing stop level 1.5 ATRs above. The next day takes right off. I hit multiple profit targets, so I'm reducing my position size. But as of yet, we have not got to trailing stop level. We haven't got to trailing stop level, and we haven't closed below my line in the sand of the 200-day moving average. So nice big up move bar here. And then 3 days down, you can see here on the 16th, we did go below the 200 during the day, but it recovered and closed above. So I kept the trade. Next day went up, took a profit target into that strength. The next day down again, tested the area below the 200-day moving average. No more sellers down there, closed above. And then Friday up, where I did hit one profit target. So not a big gain on this one, but I'm still in the trade, and it is still profitable, 0.67%. And so moving forward, if it continues to move up, I will continue to take partial profits. If it goes down and closes below the 200-day moving average, okay, I'm out. I'm done, right? And that's that. So the remaining shares up 0.67%. Meta. Okay, Meta, kind of a different setup here. One of the setups that I really love. I teach this to my students, and they don't happen a lot, but when they happen, they're really strong. I entered Meta on the 12th of September at 756.02. This is what is called a higher low V2 in the value zone. The value zone, I want to bring your attention to the two green lines here. Here's a green line. Here's a green line. This is the 1 ATR channel. This is the negative 1 ATR channel. So the requirements for a higher low V1 or V2 is, first of all, we need to close below the low, or we need to close below the bottom green line. We need to close below the value zone. You can see here we're below the value zone. Here we're below the value zone. Here below the value zone. So the first requirement, you need to close below the value zone. The second requirement is that you need to come back in the value zone. The third requirement is that you need a pullback followed by some kind of V1 or V2, okay? And the day that I entered is a V1. Here is bar 1, here is bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. And the reason this is called a higher low V1, V2 is, here's your V1. This low, is this low higher than this low? Certainly is. Did it close in the value zone? It certainly did. So there you go. Higher low V1 in the value zone. We close below the value zone. We come into the value zone. We pull back. We have a V1 or a V2, which low is higher than the first low. And that was the entry. I entered here at 756.02. I placed my emergency stop 2 ATRs below as always. And then my end of bar stop on a V1 or a V2 is halfway of the washout bar. On a V2, or on a V1 or a V2, the second bar is always the washout bar. And so you take the low of the washout bar, the high of the washout bar, halfway of that, I guess I wrote this just a little bit wrong. There we go. Halfway of that is my stop. So I entered here 756.02. If the next day it had closed, remember it has to be closed. If it had closed below halfway of this washout bar of the orange line, I simply would have got out. So you see my risk is very small, right? Which it always should be. So 756.02, next day takes off like a rocket ship, multiple profit targets. Next day, up again. And on this particular day, I get to trailing stop mode. So now I'm in trailing stop mode. Next day, down a little bit. Next day, at the high of the day, it was up for enough for me to take a profit target. And on Friday, went up, and at the high of the day, another profit target. So every single time it has a move up, whether it holds or not, I sell into that strength. So now, when it was at its highs in the last couple days, we did get to a 65 RSI level. So I have a rule that I use, I have a rule that I teach my students, that if I ever get to a 65 RSI level, now the 5 EMA comes into play. This is this light blue line here. In the future now, if I close below this 5 EMA, that's the end of the trade for me. That's it, right? Because the 5 EMA is a fast-acting moving average that is going to follow this price very closely, and it's a good tight stop when you get into these elevated levels. So Friday, you can see during the day we were below the 5 EMA. Had it closed below the 5 EMA, I would have exited the trade, but it did recover and closed above. But going forward, if it closes below the 5 EMA, I'm going to be out of the trade. So this particular trade, the remaining shares that I have here on Meta, up 2.87%. MSTR. All right, MSTR. Good example here in combination of two different strategies happening at the same time. This is a deep dip buy and a higher low V2. Remember, what's a higher low V1 or V2? We have to close below the value zone, which the high of the value zone is the green line, the bottom green line is the bottom of the value zone. Did we close below the value zone? Yes, we did. Did we come into the value zone? Yes, we did. Did we pull back and then create a V2? Here's the V2, bar 1, bar 2, bar 3. Bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. That is a higher low V2. By itself, legitimate. But on top of that, do you see the purple line here? This purple line is the 250-day moving average. This is a deep dip buy. Close under, close over. Either one of those are legitimate by themselves, but they both happened on the same day. And so that is why I took the trade. So I entered here 333.33. I placed my emergency stop 2 ATRs below. My end of bar stop is a close below halfway of the washout bar, just like I showed you on Meta, right? Here's the washout bar, the low, here's the high. Halfway of that is my end of bar stop. You can see the very next day we did go down and test that halfway, but we closed above. That's what kept me in the trade. And then the next day we had a huge day up where I hit multiple profit targets, and I'm also in trailing stop mode. I didn't do anything on Friday because we didn't close below the previous bar's low. So this trade here, the remaining shares that I have in MSTR doing very well, up 3.32%. And again, the previous day when we had the big, huge up, I exited some of these shares, some of the position up here much higher, selling into that strength. But again, this is a good example of the confluence of signals happening. A higher low V2 in the value zone and a close over the 250-day moving average, which is a deep dip buy. So up 3.32%. All right, the last daily open position is McDonald's, MCD. I entered this on Thursday at 301.07. So why did I enter? Well, it's a green box. That means we have a bullish order block. We look to the past here. We have a swing low, followed by a swing high, followed by a lower swing low, followed by market structure change. As soon as we have the market structure change, it defines the order block. We look for the lowest bar close before market structure change. We highlight the high and the low of the order block. We bring that into the future. And if we come back to that area, that is an area that is highly likely to have support and to move back up. Doesn't always happen, but it happens more time than it's not. So I entered McDonald's inside the order block, right? It didn't reject the high, it didn't reject the low, but I entered McDonald's inside the order block because it rejected the 200-day moving average. An intraday rejection of the 200-day moving average by itself is a legitimate entry signal, but when you enter the 200-day move, if you have a rejection of the 200-day moving average inside a bullish order block, it's even better. So I entered 301.07, position size correctly, placed my emergency stop 2 ATRs below, placed my trailing stop level 1.5 ATRs above. My end of bar stop is simply a close below the 200-day moving average. So you can see it's close. It's a good risk to reward ratio. Was up nicely, or it was at its high yesterday, it was up pretty good, and I did take off a profit target. So it's a new position, not up a lot, but it still is up 0.47%. So it's looking good. So, all these were monster positions. A lot of them were monster positions. And you can see I use the order blocks, the higher low V1s, V2s, the deep dip buys, or in conjunction, putting them all together. And this is how I trade. This is how I make a living. This is what I teach my students. I'll talk about it a little later in the podcast, but I do teach a one-on-one course. I've taught people all over the world, and it's one-on-one. I think it's the best way to learn anything. It's a 20-hour course, and I teach you all the strategies that I use. I teach you all the rules that I use. I teach people from absolute beginners all the way up to the hedge fund level and everywhere in between. But if you would like to learn how to trade these strategies and trade them well, I'll teach you exactly how to do it. And we'll spend 20 hours together. And it's a long time, but really, a lot of people try to learn from 1 or 2 hours. I just don't see how it's possible. You need repetition. You need time in to learn these. So if I can help you, and if you'd like to become my student, just send me an email. The email is in the link of the description of this YouTube video. So those are all the dailies. Now let's talk about the weeklies. Weekly trades on the weekly charts I take on Friday, because the Friday is the end of the bar. That's when the bar closes. So I like to trade dailies. I also like to trade weeklies. But again, the weeklies, I take my signals only on Friday because that is when the bar closes. So let's talk about XLV. And again, these are weekly bars. Okay, so XLV, if you've been watching the channel, when XLV was up here, I was talking about waiting for XLV to come down to the sweet spot of where I wanted to buy XLV. And I waited, I don't know, 2 months to take this trade. And this is a good teaching moment. Two months into the future, I saw the level that I wanted it to get to. And I didn't want to mess with the trade until it got to that level. So I was patient. I waited for it to come exactly where I wanted to take the trade, and it happened. I took the trade, and it's done very well. So I entered here on the 8th of August at 130.07, $130.07. Why? Multiple confluence of signals. We have the order block, and we also have the 300-week moving average. So it's an order block deep dip buy combination. Two primary signals. I was waiting for it to come down, reject the high of the order block, and or reject the 300-day moving average, week moving average, excuse me, and it did. This week, it just tagged the 300-day moving average to the penny and also rejected the high of the order block. So I entered $130.07. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this 300-day moving average. So the risk to reward ratio is very good. I placed my 1.5 trailing stop level above. The next bar takes right off, as it often does. Hit multiple profit targets on this move up, reducing my position on this big bar. The next week up again, took another profit target, and now puts me in trailing stop mode. Since that time, we have just moved sideways. We have not had a close below previous bar's low, so I have not had to take any action whatsoever. If it continues to move up, I'll continue to take partial profits until we get to a 65 RSI level, then the 5 EMA will come into play. If it heads down, I will continue to hold it until we have if it heads down and we have a close below previous bar's low, I'll exit half, right? Because I'm in trailing stop level. Ultimately, if it heads back down and closes under the 300-day moving average, I'll have to get out, right? So I know exactly what I'm going to do regardless of what it does. And that is where you need to be as a trader. You need to have rules, if-then statements. If it does this, I'm going to do that. If it does that, I'm going to do this. You have to be like a computer program and just let all the excitement and impulsiveness go away and just follow your plan. So this trade is doing very well. The remaining shares that I have on XLV up 5.24%. UUP, interesting. UUP is the dollar. I entered the dollar all the way back here on 7/11/2025. Confluence of signals. Rejection of the order block. Close under, close over the 200-day moving average. Two primary signals. I got in 27.21. I position size. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close under the 200-day moving average. I placed my 1.5 ATR trailing stop level above. Next week went up, next week went down. Then we had a big move up here where I took partial profits and also got to trailing stop mode. Next week down again. We have our first close below a previous bar's low after reaching trailing stop level. What do? I take off half. I took off half for a gain of 0.51. And then for a month, we have just moved sideways. But then look what happened here this week. During the week, we were under my stop of the 200-day moving average, right? But I didn't do anything because I wait for the close of the bar. And then we had a huge, big reversal back up. V1, do you see it? Bar 1, bar 2 goes under bar 1's low, closes above bar 1's close. That's a very good, strong indication. Am I still in the trade? Yes. Why? Because it's still above the 200-day moving average. If I was not in this position, I may have entered this position Friday because of the intra-week rejection of the 200 plus the V1. Just saying, but I didn't. I was in it back here. So the remaining shares that I have on UUP up 0.84%. TLT, I've been in this trade for a long time, everybody. These are bonds, and it's been a good trade. All in all, I've been in it forever. I'm in it a lot longer than I am most trades. I got in this trade all the way back here on the 17th of January. Why? Rejection of the high of the order block plus a V1. I got in at 87.20. Just took off ever since I bought it, just went up, hit multiple profit targets, got to trailing stop level, multiple profit targets here, then sideways move, then big move up here, multiple profit targets, and then we had this huge move down on bonds. I don't know if you remember that. I do, where we closed below the previous bar's low after I was in trailing stop level, and I did take a loss of 0.58% on this, on half, but I kept the other half because we did not close below the low of the order block. Then we continued to move up, took profit targets, been all over the place, went straight down for a month, but did not close below the low of the order block. So just continued to stay with the trade here. We moved our way up. I did take some partial profits, and we had 3 weeks down. Then we had 3 weeks up. Again, every time it was a larger up bar, I would take profit targets, and we moved down. And then over the last 3 weeks, here took multiple profit targets. Next week after, multiple profit targets. And so the remaining shares that I have on this trade, not up a ton, up 2.06%, but TLT pays over a 4% dividend, and it pays it monthly. So this one, I have gotten a dividend on this for almost a year. So I've gotten the dividend and I'm profitable on the trade. So it's worked out pretty well. So anyway, we'll just see what happens with TLT. I'll just follow my process, but up 2.06%. And then last but not least, everybody, is Amazon. Amazon, here you see a red box. This is a bearish order block. Swing high, swing low, higher swing high, market structure change. As soon as the market structure changes, I can identify the bearish order block. It's the high and the low of the highest up bar close. We bring that into the future. I identified this thick red line here. If you look here on the 7th of February, we had a big down bar. If you have a big down bar and you rally back to halfway of that big down bar, that is generally where you will find some resistance. And so this is the line. I don't have a 250-day moving average or a major moving average inside of this order block. So I created my own level, which is halfway of the big down bar here on February 7th. And you can see as soon as we got to that level, it rejected it, it came down. Then it did it again here on the 15th of August. We rejected that level. I got short here, 230.90. And my stop is a close over 233.70. So this one is slightly underwater. It is down 0.29%. So I almost ran the table on all the positions being positive this week. But this one is a small loss, but it's very small. And it's fine, right? But my rules are telling me unless it closes above 233.70, I am still short Amazon because of the rejection of the halfway in the order block at 233.70. And next week, if it closes above, I will simply get out. So, boy, that I think on this podcast, I have more positions than I ever have, but I hope that was helpful for you to see all the different strategies and how I'm managing these. And you can see a lot more winners than losers, right? So if that was helpful, I would appreciate if you could hit the thumbs up button. It really does help the channel. And before we get on to the trades for next week, let's quickly do a little bit on trader psychology. This is from my good friend Steve Burns, great trader, great author. Check out his books on Amazon. Steve was a coach and a mentor of mine in the past, and really outstanding individual, and you'll learn a lot from his books. But and you can follow him at @SJosephBurns over on X. But let's see what Steve has to say. The 3 trading account destroyers. over leveraged, over trading, and revenge trading. Stay away from these. 100% over leveraged. Listen, when you're leveraged, that knife cuts both ways. When you're right, it's great, it's fun, everything's wonderful. But when it goes against you, not so great. And that really can destroy your account. My suggestion would be not use leverage if possible. My suggestion, use cash, no leverage, take the long view of trading, grind it out, make a nice return, make a nice living. As soon as you start getting into leverage, now you are opening yourself up to larger losses. You're opening yourself up to a lot more volatility in your emotions. So leverage is dangerous in my opinion. Personally, I wouldn't use it. Over trading, people get a rush, they get a buzz from trading. It's just like a drug. And if you get into the habit of looking for this rush every day, it's a bad thing because you're conditioning your body. You want the excitement. Trading should not be exciting. It should be boring. Sounds counterintuitive, right? But it's correct. It should be boring. And you should try to put yourself into a place where you are under trading. Under trading is better than over trading. And I've been through it all in my over 30-year career. And I can tell you that when I kind of get into that mode of, oh, okay, I'm running and gunning and this and that, yeah, it's fun, it's exciting, but I always do better when I undertrade. I mean, it's just all there is to it. I do better when I undertrade. So try not to get into the habit of overtrading. Oh, I want to try this. I want to try this strategy. I want to do this. I want to do that. The longevity, it's just a lot more holistic way to trade when you undertrade. And at the end of the day, I really sincerely mean this. I think you're going to make more money by undertrading. And revenge trading, well, we all know this one. Oh, that IBM, man, I lost on IBM 3 times. I've got to make my money back on IBM. You don't want to make it on Intel? No, has to be IBM because that's what it took for me for the first time. It's so dumb, right? Sometimes we're just so dumb, but I get it. I completely understand. Revenge trading is horrible. If you even think to yourself, oh, I got to get this back on that, just walk away from it. I'm telling you, just walk away. And again, this all comes back to trading psychology of getting yourself a proper trading plan, proper trading process, proper trading strategy, and following it. If you're following your plan correctly, revenge trading is out of the equation, right? And, if you don't have a plan, if you don't have a trading process, like I said a little earlier, I'd be glad to teach you what I use step by step, all the bases covered. If you use what I teach you over time, you should do just fine if you do it exactly the way I teach you. So if you don't have a trading process, just contact me. I'm very happy to teach you in my one-on-one course, and you'll have a good, proper trading plan that you can use going forward. So 3 trading count destroyers: over leveraged, over trading, revenge trading. Stay away from these. Steve is 100% correct as usual. Okay, let us take a look at the potentials for next week. So I have 9 daily potentials here. I don't have anything on the weekly this week. And I have 9. And so I always mention this, but it's possible that all 9 of these signals could trigger tomorrow. Does that mean I would take 9? Absolutely not. I only take 1 per day or 1 per time frame. Even if all 9 of them are perfect, great, I still have to look at them and narrow them down to the best one. I was just talking about over trading with Steve Burns, right? With his posts. The reason I do this, it causes me not to overtrade. If I can only take 1 trade per day and I have multiple candidates, I have to go through each one with a fine-tooth comb and find the best one. Which one has the most confluences? Which one has the most signals? Which one has the best risk to reward ratio. You could have one trade that has like 4 different signals, but it has a horrible risk to reward ratio. If that's the case, you might want to pass on that. So it's a fine line, right, of balancing everything. So how many signals? What's the risk to reward ratio? What does it look like on higher time frames? What's the relative strength of this market compared to the other? And what I mean by that is if the market's down and you have 5 signals, maybe there's one that's a legitimate signal that's actually up. Well, that's probably the one I'm going to take, everything else being equal, because that had a stronger stronger, relatively speaking, than the rest of the market. Had the market been up that day, it probably would have been up more, right? So again, this is what I teach my students, how to do this, how to narrow down and take the very, very best trade. So I'd love to have you as a student. Just send me an email. It's in the link of this YouTube, and we can get the conversation started. But the 20-hour one-on-one course, it's worth every single penny, everyone, and you'll have a skill that you can use the rest of your life. And as a secondary option, I have a really good online video course, Deep Dip Buy, the Deep Dip Buy stock trading strategy. You've heard me talk about deep dip buys a lot today. And that's at udemy.com. That's a 9.5-hour course. It doesn't teach you order blocks and higher low V1s and these kind of things, but it does teach you the deep dip buy strategy, which just by itself is a great strategy. And that course is 9.5 hours, and it's really affordable, and the link's in the description. So whether you study 20 hours one-on-one with me or you take that video course, either way, they're great products. They're really good values, and you're going to learn a lot. All right. So let's start off with the 9 potentials for next week. So here is Disney. Now, again, these trades are not going to be where they need to be yet. If they were, I probably would have already taken the trade. But Disney, of course, had this huge run up, and now we're pulling back. We're pulling back into a order block, right? Here's the order block. The high of this is 109.88. The low is 108.32. This is a deep dip, this is an order block area. I like to call these order block areas smart money areas. Well, look what's happening here. We are coming back down towards the order block area, but look what's inside of the order block, the 200-day moving average. Again, this is a order block deep dip buy potential setup. So if Disney continues to go down, it's a really good signal if we can reject the 200-day moving average and reject the high of the order block. That's a AAA rated setup. Doesn't mean it's going to be profitable, but the signals are there. The risk to reward ratio is there. So I'm just going to be watching Disney carefully to see if it will come down to 109.76 and test that area. Right now it's 113.72, and it's been weak. It's been weak compared to the rest of the market. So this is a really good entry, potential entry with a really good risk to reward. Again, doesn't mean it's going to be positive, but the stars are aligning for a good setup there. So I'll just watch it. If it gets there, I'll consider, and rejects the 200-day moving average and the high of the order block, I'll consider taking the trade. If it doesn't, I just won't take the trade. But I'm going to watch Disney carefully. This really kind of jumps out to me as a good potential entry there at the 200-day moving average in the order block. Energy transfer, ET. Okay, I have been talking about ET for weeks, maybe months. It just has not got to where I want it to get. I know exactly where I want to buy ET. It's in the order block at the 300-day moving average. That is the orange line. You see how the orange line is at the bottom of the order block here? It's perfect, but we're not there yet. But if we come down and we reject that 300-day moving average inside the bullish order block, that's a great lineup and a great potential entry. Again, doesn't mean it's going to be a positive trade, but it means that the signals are there, and it means that broader speaking more broadly about it, this is where kind of the smart money bought this last time, right? Because when it got here, obviously rallied. If it gets down here, is it smart money again? Not necessarily, but more likely than not, it is, because it was last time. And I have a very good risk to reward ratio of that Above, if it rejects the 300, above I stay in, if below I stay out. Very good. It's the best you can do with trading. Look for the signals with a good risk reward ratio, have a plan. If you lose, if it loses that level, just get out. You can always get back in. So I'm looking for a rejection of the 300-day moving average, which is 1691 inside the bullish order block in the coming week on ET. Palantir. Okay, so Palantir PLTR looks extremely bullish, obviously, but we do have a bearish order block up here. And here on the 13th, we have a big down bar. Remember, if I have a big down bar and we rally into halfway of that big down bar, there's going to be inherent resistance there. So that's what I'm looking for. We are inside the bearish order block right now, but I'm not going to take the trade there. I'm going to look for a rally up and reject that 186.30 level. If it does that, then I'll consider taking the short trade. I'll position size. I'll place my emergency stop 2 ATRs above, and then my end of bar stop will simply be a close of 186.30. I'm only going to take it if it rejects 186.30. So if it rejects 186.30, then 186.30 will be above me. And then if it closes above, I'll get out. But if I'm right, then have a nice possibility for a nice move down on the short side. So again, risk to reward. So just to be clear, I'm looking for a rejection of 186.30 next week on Palantir, and if it does, I'll consider getting short there. UNG, which is natural gas. I like this trade. This is an order block. Why is it an order block? Look over here. Swing low, swing high, lower swing low, market structure change. The market structure change defines the order block. We take the high and the low of the order block, we move it into the future. If we come down, reject the high of that order block, I would consider getting long UNG. If it comes down further, rejects the bottom of the order block, I will consider getting long UNG. Either way, I have a good risk to reward ratio with the potential for a nice big reward. I mean, this move up on natural gas, you can see the MACD bars are very strong. I would be surprised if it just comes down and goes lower. I'm not surprised, however, when you have a change in market structure to the upside and you come back and you retest before you take it off again to the upside. And that, of course, is what I would be looking for. But regardless, I'm not going to get into the trade unless we reject the high or the low of the order block of 825. The high is 1201, the low is 1173. So in this area is where I'd be looking for potential entry on UNG. VIX. Well, VIX has just gone down and down and down and down and down because the market has gone up and up and up. But listen, I can see a lot of things on VIX that are telling me that we could have a potential bounce. Let's look at the MACD. MACD are the red bars here and the green bars here. Look, are we lower here than we were over here? Obviously. Are there any red bars here like there were red bars here? No. You know, I studied this one-on-one with Dr. Alexander Elder. This is called a double bottom with a bullish divergence and a missing right shoulder. From a MACD perspective, even though we have gone down, 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 the math on the MACD is saying that the momentum, the selling momentum to the downside is running out. Otherwise, we would have deep red MACDs. And if the selling momentum is running out, the implication is you're running out of sellers, and the implication is you're going to go up. If VIX goes up, the market most likely is going to go down. So what I am looking for here, I've been looking for an entry on VIX because of this double bottom, bullish divergent, missing right shoulder, looking for a deep dip buy with a close over the 30 RSI. Look where we closed, 29.93. So if we move up and close above the 30 RSI next week, I may potentially get long VIX, depending, if it closes up at 50 RSI, I'm not going to do that because the 30 RSI is going to be my stop. But if it has a nice gentle close over the 30 RSI, I would consider getting long there. But the other thing I want to show you is we have the potential to change market structure on VIX. Look, here's a swing low, followed by a swing high, followed by a lower swing low, all we have to do, all VIX has to do is get above this swing high here at about 34.58. If that happens, now VIX has gone into a bullish market structure. And if VIX goes into a bullish market structure, that's concerning for the rest of the market, for the regular market. So I'm going to watch this very carefully. And if it closes nice, gentle above the 30 RSI, I will consider getting in. If it just races right through this, then I won't, but then I'll have an order block formed, because if we take out the swing high, I'll know the order blocks. It would be the high and the low of this bar here going forward. And then if we pull back into that, then I could buy that way. So two different ways. Nice gentle close over the 30 RSI, I'd consider getting long, or if we head up, change market structure to the upside, then I'd look to buy the dip back to the order block. But watch this on VIX, because if we take out this swing high here at 34.58, very likely that will probably, at least in the short term, identify the high of the market. Verizon. Okay, been talking about Verizon for a while, just waiting patiently. Here's my order block that formed here, 8.625, that order block going into the future. If we come back, if we come down, reject the high of the order block, or reject here 42.59, which is halfway of the big up bar. So if you have a big up bar and you come back to halfway, that is a buyable area. So a rejection of the high of the order block, 42.80, a rejection of the low of the order block, 42.31, or a rejection of the halfway bar here of the 7th of August at 42.59. That is where I would consider getting long Verizon. But it's not there yet, so I don't do anything. WES is another one that I've been looking for to get to a certain area. I know exactly where I want to buy it. Here's your order block. It's a wide order block, so I don't want to mess with it unless we reject the 200-day moving average. It's pretty close. Actually got pretty close on Friday. But if we come down and reject the 200-day moving average, which is 37.88 inside the bullish order block, that'd be a good entry point. Again, doesn't mean it's going to be a positive trade, but it would be a good, smart entry point with a good risk to reward ratio. And then last but not least is XLRE, which is real estate. Well, we have an order block here. The high of the order block is 41.66. The low is 41.34. Why is it an order block? Swing low, swing high, lower swing low, market structure change. As soon as we change the market structure, we can identify the order block, lowest bar close before market structure change. The high and the low of this order block is 41.66. The low is 41.34. Run it into the future. What's living inside of the order block at the moment? The 200-day moving average. So next week, if we continue down and then we reject the 200-day moving average inside the order block, that would be the potential entry for me on XLRE. So a lot of positions we went over today. I hope it was helpful. If you have any questions on anything, please type it in the comment section. I will do my best to get back to you and answer your question. I hope you have a really good rest of your weekend, everybody. Please be careful. The market really is strong, but things can change quickly. So keep that in mind. If I can help you with your trading, just contact me. I would love to be your coach. I would love to be your teacher. I'll teach you every single thing I know. I do private consulting right now for hedge funds and multiple financial companies. So if you want any private consulting, please let me know. Be happy to help you with that. But I really would love to have you as a student. I love teaching students. I love to see them succeed and to learn a new skill. So I'm just going to lead you off with, please have a good rest of your weekend. If you can try to do a nice thing for someone every day. If we all did a nice thing every day for someone, it would make the world a better place. If you could try to go out, do one nice thing for an animal each day, if you have the opportunity, that would be great. They enjoy acts of kindness just like we do. The world's a crazy place. I think we could use some good vibes and we could use some kindness, right? I think we need a little bit more of that. So, let it start with us, right? So be careful next week. really be careful. Enjoy the rest of your weekend, and I really appreciate you being here. Take care, everyone. Bye-bye.
U.S. government disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.